Welcome to Deep Economic Thoughts with economist and best-selling author Ivan Elon. Once in a while, Ivan shares an unscripted, though potent, idea related to economics or the capital markets. This may be of interest to financial advisors and retail investors alike. Enjoy.
Welcome back. This is Ivan Elon, and I'm going to talk about market breadth today. Recording this on Friday, June 9th. The data I will reference in this episode is from Wednesday, June 7th. And you've been hearing a lot in the news, or maybe not, you haven't, but it's been a big news item that something called market breadth has been very narrow, meaning that very few companies within the market, and we'll talk about the different parts of the market in a second, but that the number of companies in the market that are outperforming the index year to date is very, very few. As a matter of fact, a piece of research that has been circulating quite a bit is that only 7 companies within the S&P 500 index are actually responsible for nearly 100% of the return of the S&P 500 year to date. And those companies include NVIDIA, Meta, Tesla, Amazon, Alphabet, Microsoft, Apple. Now, so basically, I mean, it's a pretty stunning thing. If you just look at the performance of those companies, they're up quite significantly. NVIDIA up 165% this year, Meta up 125%, Tesla up 80%, Amazon up 51%, Apple up 38%. Meanwhile, the S&P 500 index is up essentially only, let's call it a little over 11%. And again, this is as of Wednesday of this week, June 7th. So what makes this so interesting is that beyond these 7, there's actually about 140 stocks within the S&P 500 that are actually doing better than 11.22%, which is the year-to-date return on the S&P 500. Which is essentially 28% of the constituents within that index that are actually doing better than the cumulative index, which is 11%. So there is actually some greater breadth in the market, but it is absolutely quite limited. And what makes it even more limited is because the S&P 500 is what is termed as a market capitalization weighted index, meaning the bigger companies, the bigger sized market cap, the more valuable companies that are out there, those are ones that actually get the highest weightings in the index. So for example, Apple is the number 1 largest company in the S&P 500, and it represents 7.45%. That one company represents 7.45% of the S&P 500. The next largest company is Microsoft. It's 6.98%. Amazon, 3.12%. NVIDIA is now 2.7%. Alphabet, between its 2 share classes, is nearly 4%. They break it out into 2 share classes. Google is 2.09%, and Goog is just 1.83%. Meta, 1.7%, and Tesla, 1.63%. So if Apple is 7.45% of the index and Apple is up 38%, that's going to mean the S&P 500 is going to be really benefiting from that in a significant way. NVIDIA up 165% and represents nearly 3% of the allocation of the S&P 500. That's going to be a huge upside win for the S&P 500. However, again, and this is the point of talking about market breadth, it does not represent what is really happening in the U.S. stock market. The vast majority of companies in the S&P 500, 72%, in fact, are performing below what the S&P 500 has been returning year to date. So the S&P is up about 11% year to date. 72% of those companies are below that, many well below that. And so when you actually look at the aggregate of those other companies, they're essentially flat on the year, almost with maybe a little positive or slightly negative return. So that's a very important thing to keep in mind. And then when you look at other indexes like the S&P 400, which is a mid-cap index, or the S&P 600, which is a small-cap index, boy, do those tell a very different story. Within the S&P 400, which is a mid-cap index, about 45% of that index, of the constituents within that index, are performing at or better than the year-to-date figure for the S&P 400, which is about 5.4%. So half of the S&P 400 is actually performing at or better than 5.4%. But when you look at the top performers, just looking at companies that are in the top 10 of the S&P 400, which again is a market cap weighted index, the number one holding within the S&P 400, the number one constituent in weightings is Builders First Source, and that weighting is 0.84%, not even 1%. So this is exactly the point to keep in mind, which is in the S&P 500, you've got enormous concentration within just a few companies. About a third of the index is within just these few top, call it, 10, 15 companies. And you look at something like the S&P 400, and it takes you quite a number of constituents to equal the weighting of just the top 10 that are in the S&P 500. So even though Builders First Source is up 91% this year, it only represents 0.84%. Compare that to an NVIDIA, which is 2.69%, nearly 3 times the weighting, and it's up 165%. You start to appreciate how impactful it is when a very large company has a very big upswing. It is not necessarily representative of what is happening in the broader U.S. stock market. And certainly a little while ago in Forbes, I wrote an article that the U.S. stock market is not a monolith, meaning that it's not just all about the S&P 500. There's so much market capitalization spread across so many companies, including within the S&P 500, considering when you really think that 72% of the S&P 500 is not performing as well as its own index return. And most of them certainly doing much, much worse than that. So that's the S&P 400, talking about that. There's only a couple of companies there that are even in the top 10 that have performed fairly well. And then the S&P 600, Axcelis Technology. By the way, all of these companies that I'm talking about, we do not have any, our firm at AWAME, we do not have any ownership on any of these individual securities that I am mentioning. We only buy exposures through index funds within these various market segments. But we do not own any of these securities that I'm mentioning, which is an important disclosure. But you look at the S&P 600, Axcelis Technology, and it represents 0.59% within the S&P 600. And so even though it's up 108% year to date, the S&P 600 is up only 5%, 5.8%. So the S&P 600 small cap index, it's up a little over 5. The S&P 400, a mid-cap index, is up, maybe 5.5, you could say. But the S&P 500 is up over 11%, more than double what these other market segments are doing. But let's not confuse that it's doing better because the whole of the S&P 500 is doing so well and large cap companies are doing so well. It's that this very narrow leadership of companies with Nvidia, Meta, Tesla, Amazon, Alphabet, Microsoft, Apple, they are carrying that index higher because of their phenomenal performance. So just as it has had this incredible upswing because of that narrow concentration, guess what? That is a vulnerability for when the tides turn. And when there is a movement negative for those companies, those market leaders within the S&P, it will also take the S&P 500 down potentially quite significantly. However, that does not mean that all of these other constituents of the S&P 500 are going to perform accordingly. So this is, I think, such an important part of understanding market indexes. And what are they really representing? What are they really showing us about how our stock market is doing? Right now, the U.S. stock market is in a relative malaise, but you wouldn't think that by looking at, the NASDAQ up, nearly 30% this year, or the S&P up double digits as well. And yet, the majority of stocks within the U.S. stock market have really done pretty much nothing. I mean, have been pretty, sanguine. And so that's something to keep in mind when you think about how well the market's doing. It isn't necessarily a reflection of all the market. It may just be a reflection of a very few set of stocks that are doing very well. Look forward to next time.
For more deep thoughts, please subscribe to this podcast. Also, please feel free to visit www.ivanilon.com to submit questions or topics through the contact page. Until next time, keep thinking deeply.